This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more. Welcome back to the Commercial Real Estate Investor Podcast. We are live for another episode of the Brokers Roundtable. It's been over a month since I've been with these guys, so excited to be back at it with them. And today we're going to be diving into distressed commercial properties. Is that going to be the big opportunity in 2025? You know, Ken Griffin just took a major loss, $50 million loss on some condos in Chicago. We had a seller out of the Northeast here in Nashville sell a couple of towers here for a combined loss of $115 million, as well as numerous other deals. If you go to The Real Deal or any of the online news sources that are tracking commercial real estate opportunities, it seems like there are some pretty major losses that are starting to hit the books, which isn't really surprising if you look at the timing. 5 years ago was January of 2020, right? So some of these assets are towards the end of their life cycle, and they didn't really have a good start. So I want to dive into the landscape of distressed deals first. And Chad, I'm going to kick it off with you, man. Industrial seems to be faring relatively well in terms of distress in the market, unlike office, multifamily, some of the other asset types. What trends are you seeing in industrial real estate that could signal distress or opportunity for investors?
Yeah, great to see you guys as well again. I can see everybody's rocking a beard, which is also really good to see. So great question teed up. I think the biggest thing that I say to people more than anything else right now is that you really need to differentiate industrial into subcategories. So you usually will see a market statistic. So it'll say industrial real estate nationally is 5%, just using an arbitrary number. And they might get a little bit deeper and say, well, Nashville is 4% or Chicago is 7%. But that doesn't really tell the whole story. You need to go a lot deeper and delineate it between big box warehousing and small and medium-sized bays, because there's a huge difference in market fundamentals between a 500,000 square foot warehouse and a 5,000 square foot building that's sitting on 2 acres of yard. There's just a huge difference between the two. So I think it's really incumbent on anybody to go in and understand exactly what you're trying to compare for that proverbial apples to apples comparison. And where I see some opportunity right now is perhaps on that big box space, as a lot of it struggled over the last 18 months, mostly just as a run up of inventory that got added over the last 3 or 4 years. Developers love to develop, and when industrial looks as attractive as it did in 2021, 22, the developers just seem to think that demand growth would continue in perpetuity, and it's slowed down. So now there's a glut of big box warehouse space all over North America. So I can see some distress in that area coming. The challenge is most of that is big institutional owned property. So it's hard for an average investor or a syndicator to go and pull down a $50 million portfolio when on the other end, that small bay industrial or flex or IOS, the other end of industrial, that's still very competitive. There's still very low vacancy rates. There's still climbing growth rates. So I think if somebody's got the appetite right now, and I think that there'll be well-financed, well-capitalized funds right now that go out and take advantage of some of this distress. But on the industrial side, that's where I see it. Distress, potential opportunities on the big box warehouse. Everything else is still very competitive.
That's interesting. It makes sense because a lot of the industrial developers that we've seen over the last 10 years have shifted into building the much bigger distribution centers and away from the smaller, more local, flex type of deals. Jesse, let's talk about this Nashville example a little bit. I mean, one of the towers was only 45% occupied, right? And these are in the downtown core of Nashville. I don't think that this is unique to Nashville. I think the downtown cores of a lot of cities are kind of struggling because there's a lot of traffic. It's tough to park. It's tough to navigate, especially in like the southeast of the United States, right? We don't have transit, which makes it a nightmare. But I mean, how have remote work and higher vacancies really impacted the office sector? It seems like we're starting to kind of see the fallout now.
Yeah, I think the chat's point to like even on the office side, you kind of have to break down the office into the subcategories that we've talked about on the show before. So I mean that goes for C, B, A class trophy assets. In a lot of markets, you're starting to see a lot of the distress happen with the Bs and Cs, not surprisingly. Those are buildings that typically are not in the best areas, even if they're downtown. And as well as they're not amenitized like the A and trophy assets. Just for an example, like our market, I think we're at 4 or 5% vacancy in the trophy asset class, but when you go to the general downtown market, we're closer to like 21% or maybe 22% availability, 17% vacancy. So I think now that with the backdrop of the trend of back to work, I've actually seen most of the statistics that we take out in the major markets in the US and Canada, we've started to see the back to work actually creep up the percentage of return to office. So that is starting to happen. But I think the reality is that a lot of the product that we have now is not necessarily going to be utilized. So the big question is what ends up happening with these properties? Do they get repurposed in some fashion? Is it just full redevelopments? We're in a weird part of the market for development in general. So, I mean, if anybody says that they kind of know what's going to happen in the next couple of years, I think you'd be hard pressed to have a clear answer on that.
Yeah, I mean, there is no easy answer, right? And I think that's what's really tough about where the market is right now, because everybody's knee-jerk reaction is, oh, we need housing, convert them into apartments. Well, one, the cost of construction right now today compared to 5 years ago is astronomically high. Two, those buildings just aren't laid out for that. So it just doesn't work in most cases. Adam.
Yeah, absolutely.
Yeah, I mean, Adam, are you seeing any similar risks or pressures in the retail space? Maybe consumer behavior is changing. I know that we've kind of hit an inflection point where the American consumer has more debt than they've had in a long, long time.
Yeah, we're not seeing the same pressures related to the economy. Like obviously luxury has really cooled down in the last 6 months. But that's such a small part of the market outside of like your major metros. Some of the pressure that we're seeing is honestly driven by the office demand that Jesse was just talking about, or kind of the vacancy issues that Jesse was talking about. If you go, like in Charlotte, for instance, we've got our uptown CBD, and then right next to it is an area called South End, which is just like the hip, cool, where all the big apartment towers are. And the retail in uptown has been negatively affected because the vacancy in the office towers has been obviously no secret, been high since COVID. So there's just not as many footfalls on the street, which is affecting that retail. But then you go a half a mile to South End where all the apartments are, and it's freaking Mardi Gras when you're walking down the street on a Friday night. So we've seen kind of really specific pressures on specific types of retail. But if you look back, you were just talking about that 5-year period from 2020. Everybody remembers that it was retail apocalypse and nothing was going to be bought anywhere except for Amazon for the rest of our lives. And if you were any kind of retail business, you were going out of business. I mean, that feels like a long time ago, but it takes a long time to build and entitle retail projects. And to your point, it's insanely expensive to build out of the ground right now. So there wasn't anything new built a while back, and now it's really hard to build. So that actually has put a lot of pressure on existing retail in a good way. Like if you've got well-positioned retail, you're probably sitting pretty right now, and your rents are probably going up if it's in a decent area. So it's kind of counterintuitive.
Something interesting that all you guys have really touched on or kind of danced around is that the distress is really compartmentalized, right? It's almost siloed in specific areas. I'd love to kind of pick that apart a little bit more. I mean, if I'm listening to the podcast right now, I'm thinking to myself, okay, so office is fine in some areas. How do I find office space that's good and avoid the office space that's bad, right? In some areas, retail's good. In other areas, it's bad. How do I analyze that? How do I dive into these markets and make sure that I'm not jumping into one of those deals? Chad, we'll start it off with you.
Yeah, I think the big thing right now is renewal risk for a tenant. Because with rising debt costs, everybody's facing it. Like you said, everybody coming off a 5-year debt that they placed 2020 or 2021, that's coming up for renewal in the next year. So I think there's going to be a lot of pain on that renewal rate basis. And I think tenancy is going to be that much more important. And if you can raise rates, I think that's great. But I think the impetus is to still just make sure you have cash flow, because I'm sure everybody right now is seeing this in their markets as well. Property taxes going up, insurance is going up, just CAM in general is going up. So I think having tenants in place is key. So on the industrial side, I'd probably look for what the weighted average lease term is, WALT, which just if you have one tenant, that's your WALT. If you have got multiple tenants, you start doing weighted averages for how big a space they have and how long they have left on their term. So in a lot of big institutional investors, they prefer to have a longer WALT just because they want to have that consistent cash flow. Whereas there's some value add investors that want to have a very short WALT so they can go in and do some renovations and get higher rates on a renewal or with a new tenant. I think longer term WALTs is actually going to be pretty important right now, just to ensure that we can get through this wave of high interest rates, which I don't know about you guys, maybe that's a conversation in itself, but I don't see interest rates coming down a whole lot in 2025. So I think that this problem is going to get kicked at least another year. So I just think having consistent cash flow right now is key, because it's hard to go broke if you're paying your bills.
That's right. I mean, I love to be the eternal optimist, but I'm looking at it going, I just don't see how the market's going to respond positively to interest rate drops. Like, unfortunately, I think we might have to have more hikes. I'm not an economist, though. Jesse, on the office space, how do we avoid bad office deals and how do we get into good ones?
Yeah. So I can't remember who said the phrase, you really want to have more money than months, or at the end of the month. So I think for cash flow at the end of the day, I think the WALT is a great metric as well. I would also say the building blocks, as we all know here, the building blocks of the valuation of a building is the leases that underpin it in commercial real estate. So not just having a long lease terms, because as we've seen, there's some people or some companies in these markets that have, okay, great, you got a 10-year deal, and then all of a sudden this company's filing for bankruptcy. So I think having staggered actual lease expirations, so you don't have everybody rolling at one time. And then the other thing is, if you have a building in the office example, if your risk, if you have enough ability to buy office right now and you want to take that risk depending on the market, I would say try to have more tenants rather than less, right? Play the numbers game there. If you have two big tenancies, we've seen a lot of these in our market where one of those tenants goes and then you're in a really rough situation from a landlord point of view. So I think there are deals there, but I think now more than ever, it takes more of an analysis of looking at all of the underpinning leases and understanding the makeup of those leases and seeing really with a fine-tooth comb of what kind of options those tenants have and what rights you have as a landlord if you're going to take on these buildings. So I think it's definitely something where you want to play the numbers here and not just go into something where you have all your eggs in one basket.
Yeah. Adam, what about retail, man? I mean, the most of what I'm seeing, at least here in Nashville, retail's doing pretty fine.
Yeah, Charlotte, I mean, I think you could argue rates in certain parts of Charlotte shot up so fast over the last few years. I think you're seeing some contraction in a few areas. You're hearing some kind of rumblings of people that can't pay the bill. Like areas like South End went from, mid to high 20s to into the 50s in the matter of a couple of years. So you've got some people that are paying in Charlotte pretty high numbers. So I mean, you're hearing some rumblings of that. But retail in general in Charlotte is really strong. And there's so many new areas of Charlotte. The suburbs, Charlotte, living in the city has become untenable for normal people. So you're having that kind of sprawling, explosive growth that all the bigger cities have already had. So, I mean, there's a lot of opportunity for kind of strip retail repositioning, older centers that were kind of built to a lower tier demographic that maybe you could go in, buy at a lower rent. And if you've got the capital, kind of reposition to a middle to upper end demographic. So a lot of opportunity in Charlotte, but there are certain areas where the rents have just gone up really, really fast. And people are in retail, people all want to be on the same corner. And sometimes you can get into a little bit of bidding war.
Yeah. Yeah, I've seen that. There's definitely some parts of Nashville where they went up too fast.
Well, and then you have this weird juxtaposition of tenancy too, right? You got the vape shop and then the white linen tablecloth restaurant that are 50 feet from one another.
Right.
And, you know, which is fun for like a social fabric. It kind of be fun collision space, but at the same time, it makes you kind of squint out a little bit.
Man, that is such a retail guy thing to say. Such fun fabric and collision space.
Yeah. I get paid to bullshit for a living, Tyler.
That's right. And you're amazing. You're a master at it. Owen is saying, what are WALTs? Owen, it is an acronym for weighted average lease term. So it's the average of all of the leases that are on the property that you are acquiring. I mean, guys, like my biggest takeaway from what you all are saying is just be careful, right? Do your due diligence as you're going into these deals. Make sure that you're properly analyzing the rent rolls, all of the leases. And one big thing that I would say, whether you're listening and you're on the brokerage side, you're on the investment or the development side, it doesn't really matter. Remember these times, right? Because a lot of the guys that got overextended in 2021 and 2022 either hadn't gone through a market cycle like this or they just forgot how bad it can be, right? And it's not that bad if you actually prepare for it, right? There's plenty of investors that are doing just fine today. But, you know, we've seen plenty of portfolios go way belly up in the past 12, 18, 24 months because everybody thought that those rents were going to keep going up too fast. And sometimes you got to stop.
Tyler, I'll just say too, like these are the times where people look back in the next, say, year or two. There's going to be a lot of opportunities, I think, for different asset classes. And these are the times where 5-10 years from now, people go, oh, I should have invested back then, but they don't remember how precarious it was. Or like, it seems like a slam dunk 5-10 years from now, but really, if you want to have that opportunity, like, retrospectively, you have to like really analyze on a granular level during these times, because there are going to be opportunities, but they're not going to, just knock on your front door.
I mean, you couldn't have said it any better. I mean, honestly, you completely teed me up for my next train of thought, which is creative financing, right? I mean, now is probably one of the better times to buy that we've had in a long time. I mean, let's be honest. The guys that lost $115 million on those two towers, that was somebody else's gain because they got a property. One of the buildings was sold at a $94.5 million loss. I want to say it sold for somewhere between 15 and 30 million. Can you imagine an asset 5 years ago sold for 120 million and somebody bought it today for 15 to 30? It's on sale. It's on sale. Yeah. That is a hell of a buying opportunity. So, I mean, with that being said, being creative today is probably the best thing that you can do in terms of putting these deals together. Chad, I'll let you kick us off, man, on the industrial sector. I mean, what kind of alternative financing methods are you seeing being implemented today to get these deals across the finish line?
Yeah, I think the easy one is vendor carry. So the seller will essentially act as a second position mortgage and carry debt for some predetermined rate. I just want to throw out, though, a different idea, and that's to not use financing. And I know that sounds obvious. If you can pay cash, people would, but they want to get the leverage so they can buy a bigger property. But there's nothing wrong in this market to actually consider just paying cash. Perhaps you bring in another investor. Perhaps you do a syndication where everybody is just putting in cash and you're buying it with the sole objection to hold it until rates come down, at which point then you're going to put debt on and repatriate some of that capital. I think if you remove financing right now, you're removing a lot of your downside risk because the property is never going to go to zero. Could we see a 20% decline? Maybe. I don't know. I have no idea what the future is going to be. But I do think that in the medium to long term, my investment thesis is that North America as a whole is going to look better in 5 to 10 years than it does now. So if that's what one thing I'm personally exploring more is to not even look at debt right now. Bring in a couple extra investors. If you're just going on all cash right now, and you're removing a lot of that downside risk, you still got to underwrite it properly. But if you're removing a lot of that downside risk with a short-term exit being just wait until interest rates come down 3 years, 5 years, I don't know, whatever it is, and then put debt on it at that point, then all of a sudden you're paying back a good chunk of investor capital. And now you're in a position where you should be able to ride out the next iteration of that investment. So I think that's something more people should consider right now is don't take on debt. Actually find a way to bring that in through investor capital, and then you're really mitigating any risk. If the property goes vacant, you're still going to have your operating costs, but at least you're not servicing a debt. So I think that's something I'm exploring more, and I think that should be on more people's radar as well.
Yeah, I think that's interesting. We've got several clients on the brokerage side that they're doing that, right? They're paying cash, right? And the idea is as soon as interest rates come down, we'll refinance, we'll use that cash to go buy the next property. I've also got a member in my mastermind paid cash for a development. And when it was done, instead of just putting debt on it, he went out and got a massive line of credit on the property, right? That's another thing you could do too. It's a bit of a higher interest rate, but he's also not having to pay anything today because he's not using any of it. He can use that as dry powder to go buy his next property if and when he finds one, right? Which is another interesting way to go about that. Jesse, Chad mentioned syndications, partnerships, raising capital has always been a big side of taking down these larger office buildings. What are you seeing in terms of acquisition structures today? How are these groups still going about taking down these projects? Like that group in Nashville that paid $15 to $30 million for that tower. How would you expect them to go about that?
So what we're seeing is over the last, I don't know, now 4 or 5 years, I think the operators that really didn't know what they were doing were kind of exposed. So you have a lot of investors that were, say, high net worth individuals, but maybe they never invested in real estate before. They're now feeling very skeptical about certain investors. So you really have to show that you have the operational experience. And also, this is the first time that investors got capital calls over the last 4 or 5 years in a big way. They've obviously happened before, but we saw a lot of them happen now. So I think it kind of connects with Chad's point of, putting more cash down, even if you're in a syndication, putting more cash down and then explaining the lack or the lower return on equity because you're trying to de-risk the deal. There's always that trade-off. And I mean, like the other thing too, on kind of Chad's point is there's also the do nothing, like you don't have to necessarily invest in real estate right now. That's always the future's uncertain. You got a president potentially putting tariffs on Canada. We don't know what the hell is going to happen in the next 6 months. So, I mean, there's always sit on the sidelines, and it's really hard for guys and gals in our industry, right? Because we like action and we feel like by not doing something, we're losing. But sometimes kind of taking your chips off the table and seeing how, things play out is not a bad idea as well. So I think the underpinning message is risk, and how can we lower it at these times and maybe increase it when we're in a position to be more bullish.
This is a bit of an aside, but you just brought up an interesting point that I don't know what other forum I'll be able to ask this in. I would love to get you, because I mean Jesse and Chad are both Canadian. I would love to get y'all's thoughts on what's going on with the tariff wars. Like, how do you think that's going to impact, transactions between the U.S. and Canada, and how might that impact commercial real estate on y'all's end, or just business as usual?
I can quickly say my 2 cents there. Like, from what I've seen in Trump's first term, he did talk a lot about tariffs, but he didn't really use them aside from the fact as using them as a negotiating tactic. And if they actually go into place, I actually think it's anti-conservative. I think most conservatives would, say that we like the deregulation, we like Dodge, but the tariffs are not something we're thrilled about. Now, as a real estate person, at the end of the day, he is a real estate guy. So I think our market in general is optimistic, but the tariffs, affect much more than just real estate, right? They affect other industries, of which I am not an expert in, and really probably wouldn't be able to comment on.
Chad, what about you?
Yeah, I agree. I think it's a lot of rhetoric right now. I think he's he's approaching the most important position in the world like an aggressive real estate deal, where he's just thrown out a number and maybe it's far from what he expects to get, but he's starting really aggressive and hopes to bring it off there. If it did go through, I think it'd be very, very painful for Canada. I think it would also be painful for the US. I think that would ripple through the economy in terms of inflation and delay of goods getting put there. From an energy standpoint, I think Canada would try to reroute some of their energy to other markets. So that could have price impact on oil and gas and everything down in the US. I think it would hit Canada the worst. I think I'd be very worried if he did actually enact a 25% tariff. I hope, and I have no idea, I'm the farthest thing from a geopolitical strategist, but I hope that it's just a posturing and rhetoric at this point, because I think it's a net loss. I think we both lose if those tariffs get put in place.
I couldn't agree more. I mean, it doesn't.
Oh, what he did with Colombia this week. I mean, there was a that was used and then immediately dropped. So hopefully it'll be more of the same.
I will say this though, just for listeners, I'm not going to speak for all Canadians, but the polling that we do have is there is no love lost with the administration that's currently in there right now. Almost all Canadians, the plurality of Canadians are ready to move on to another administration, whatever that is. So we really shot ourselves in the foot in a lot of ways in energy over the last 10 years. And I know it's kind of a crazy concept from an American audience to be able to, wait, you've had somebody in power for 10, 11, 12, 15 years. Like, it's not two terms and you're out here. Anyways, I think we're all kind of looking at the light at the end of the tunnel. So we'll see what happens.
Yeah. It seems like Trudeau is out, man. Yeah. Y'all are itching for that.
Yeah.
Well,
yeah. He's affected that party for years to come.
Yeah. No kidding.
I couldn't believe he survived the whole trucker thing, frankly. I mean, and that was, 3 years ago?
Yep.
Dude, I feel like Trudeau's been in office since he has about been in office since I was in high school. It's been a little while. Adam, bring us home, man. Where's the opportunity today? Like, what should investors and brokers be working on so that they don't miss that window?
Well, I mean, honestly, Jesse mentioned it a second ago. I was talking to one of my mentors, one of the most successful, wealthy people that I know, partner of mine, and we were talking about investing just yesterday, and he was like sheepishly talking about what he was investing in. And this is a guy that's got some commas, right? This is a smart fella, done really well, and he's like, I am working really, really hard to invest in commercial real estate right now. These deals are not easy. And he is actually investing in residential right now, even though he's a dyed-in-the-wool, hardcore, apartment developer, retail developer, has done all these things. And being a commercial real estate guy, it's really easy to like make fun of that and talk about how it, it's so simplistic and it's beneath us. But this guy could buy and sell most commercial real estate guys that I know. And the lesson that I take away from that is you've got to look for opportunity, and you've got to try really, really hard not to force things in a market like this. And I think that's really smart. So while I'd love to do nothing but invest in commercial real estate, I think you have to be smart enough to understand that the sellers have not figured out that it's not the same market that they were selling in 24 months ago. And the market hasn't really adjusted, and there's uncertainty. So sometimes it does pay to just be really selective with the deals that you do.
That's right. I think that we could all sit here and say we are grateful to not be massive shareholders of NVIDIA, and instead we have commercial real estate.
I bought yesterday. I bought the dip.
Oh, you bought the dip?
Yeah. What was it, 17? That's a big number.
I got it at 118, and I think it went 126 again today. So
that's awesome.
Yeah, I'm sure it'll bounce back. They're microchips. There's plenty of things to use them for. It'll be interesting. Anyways, guys, cheers. Thanks for joining me again. Excited to be back at it with you guys this year. If y'all are listening, don't forget to like and subscribe. And check out Adam's celebratory confetti he's throwing up.
How do you do that?
How that happened?
I love it.
Pretty sweet.
We'll see you guys in the next one.
See you.
This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more.